Let's bring in Mira Pandit now of JP Morgan Asset Management and Nicole Webb of Wealth Enhancement Group to our conversation. Ladies, it's great to add you here, post 9. So, Mira, I mean, you've heard this topic. I read you Kalanovic's note. What do you make of it?
I'm not sure that we have to retest the lows that we saw in October, but we'd still be a little bit cautious from here. And here's why. If we think about where we came into the year, markets were pricing a terminal rate of the federal funds rate at about 4.9%. Today, they are pricing 5.4%. And yet we haven't seen a huge sell-off associated with that repricing. So I'm a little bit nervous around the fact that the market is still up year to date.
That's kind of what he's pointing to, right?
And in fact,
this divergence of, as you say, these rates moving up and the equity market sort of just whistling by the graveyard, so to speak.
Either the stock market is going to hold in remarkably well, or we're in for a little bit of incremental downside. I would be biased towards a little bit of incremental downside because we've continued to see that markets are reluctant to give up rallies when they happen. And I think that we need to see a little bit of capitulation there. Not a massive amount, because, again, the journey we've been on is from 0% rates to 4.6% rates here. The Fed is moving from power to finesse. So what we're seeing incrementally here is the fine-tuning, and therefore I think the market also trades in a bit of a tighter range, which is why I don't think we have to go back to 3,500. But at the same time, right now where we are feels a little bit too optimistic.
Nicole, how do you see it?
Wide range bound rest of the year, really flat market overall. And with that, just the consistency thematically here is the market hasn't really responded to pricing in as high of a terminal rate as we're all talking about. We went into the year expecting 5.25. We're starting to change our tune that we might push further. The Fed is firm in its regard that it is managing to 2%, while we're having conversations about is 2% even real given the changes to the money supply. We have to price that in at some point. Whether we test October's lows, we don't really buy it, but range bound here on out throughout the course of the year.
S&P, NASDAQ now at session lows as we keep our eye there as we have the conversation. Now, Victoria, even you admit that the Fed isn't done.
No.
You're going to get, what, 3 more hikes, 75 basis points total. So you go from what is 8 is not enough in terms of hikes. You get to 11 hikes, and we're still going to be in a bull market.
Yeah, because that's what's anticipated now. If you look at how the market absorbed this, hey, the PCE numbers and the inflation numbers and the job print, it said, okay, we're putting in another hike, and it barely blipped. I mean, yes, it's gone down. It's been down in February, 200 basis points, give or take, whatever index. But it's also been able to absorb it because it sees an end in sight. Though I did hear a really great analogy. I have to credit the Man Group on this. You know, the Fed's going to go after inflation like Terminator and Sarah Connor. So you got to go full bore on Terminator. Got to go ahead and put him in the little molten lava lake. You can't leave any bit of inflation around. You got to kill it. And so I do think the Fed is going to be in kill mode, and they're going to stay higher for longer. I also think that's priced in. I think the only thing the market hasn't priced in is a bad earnings recession, or that we see a hard landing.
Or a deep recession to begin with, or a very hard landing. That's fair. I mean, what do you think is priced in to the market right now, Mira?
I would agree that we aren't seeing the worst of things priced in terms of recession. Even a mild recession, I don't know, is reflected in the price right now. At the same time, I don't think that we're totally priced in for the upside of avoiding all this. We don't think we're going to avoid a recession. We still do believe that the economy falls over in phases, and we're in those early phases where things like housing and manufacturing are weak. Profits are weak and getting a bit weaker. Employment is still very strong, but we can't hang our hats on that too early. So we still want to be prepared for the fact that things could get a little bit worse. But has housing rolled over? I mean, we had 8.5% increase in pending new home sales.
Well, I mean, let's not act like the party's restarted again. I mean, rates had come down as a 1-month thing. Let's back it up with another solid month as rates have moved a lot higher before.
1 month, we're not going to. I'm just kidding.
Two GDP quarters where you had a 25% contraction in that housing component, and we have seen a lot of the numbers roll over pretty significantly on a year-over-year basis. There's some bit of upturn, and I will fully acknowledge that we've seen some more momentum in the economy over the last month.